Okay, hi everyone, I'm James Harte and welcome to this Orbex Trader Education session where we're going to be talking about candlestick reading. Now, for those of you just starting to learn about Forex trading, the term candlesticks might seem a little confusing, but don't worry because over the course of this session I'm going to explain exactly what candlesticks are, their importance in reading charts, and best of all, how you can use them to successfully trade the markets. So, as ever, we'll jump right in, but if you have any questions along the way, please just write them in the chat function, and I'll stop periodically to go along, as we go along, and I'll answer those, and then we'll also have some time at the end for any questions. Okay, so what are candlesticks? In the context of trading, candlesticks, which you can see here in this image on the right, are a visual representation of price and time data. They're called candlesticks simply because the body of the candle, the body here, which is the shaded area, along with the tail or the wick, can sometimes look like a candle. So that's the name, okay? Now, I won't bore you with a long history lesson, but you might be wondering where this particular method of presenting data comes from. The method was developed in the 1600s in Japan by rice traders who used these pictorial descriptions to keep a track of price movements in each session in the rice markets. So you'll often hear or read of candlesticks being referred to as Japanese candlesticks. Okay, so don't worry, that's the history lesson over. So that's what candlesticks are. This is what they look like, okay? Now what we need to know is what they tell us about price. So looking first of all then at this green candle. First thing is that a green candle tells us that price was bullish over that trading session. So this means that price moved higher over that session. So if we were looking at this candlestick on a daily chart, it would mean that over the course of that particular day, price moved higher. If we were looking at that candlestick on a 1 hour chart, it would mean that over that particular hour, price moved higher. Now, there are 4 reference points on a candlestick that give us usable information. So the first is we have the low price here. We then have the open price, which is this point here. We have the close price, and then we have the high, which is at the top. Now, the shaded price in between the open and the close is known as the body. So on a green bullish candle, the close will always be above the open because price moved higher over that session. So price opened up here. We know that it traded down as low as this point before reversing higher and trading all the way up here. Now at some point during that session it went as high as this point here, the top of the wick, before reversing and closing at this point, okay? So there are 4 key bits of information. We know where price opened, we know how low price went, we know how high price went, and then we know where it closed. So just this simple candlestick representation can tell us all of that information about the movement of price. So hopefully you can see now why they're such a useful and effective way of displaying the data. So looking at the next candle then, the red bearish candle. So the opposite then to the green candle, a red candle simply means that price moved lower over that session. So this time we know that price opened up at this point here. At some point it went as high as this level before reversing and trading all the way down here. Now at some point in the session it went as low as this point here, the low price, before reversing higher and closing here. Okay, so again, with a bearish candle, the opposite to a bullish candle, the close will always be below the open. So with a bullish candle, the open is always below the close, and with a bearish candle, the open is always above the close. And then again, the shaded area is simply the body. So that tells us the difference between the opening price and the closing price. Now, it's important to note that candlesticks can take all sorts of different shapes and sizes. But so long as you remember each of these 4 reference points, you'll be able to work out how price moved over that session, and more importantly, what it's telling you about the market. Now sometimes there won't always be 4 visible points. Sometimes 2 of these points can overlap. So for example, you might see a candle that looks like this, okay? So you can see this candle now. This is a green bullish candle. So we know that price opened at this point here. We also know that price at some point moved all the way down to this low point here before reversing really sharply and trading all the way back up to close at this point. Now you can see that there's no upper wick on this candle. There's no tail giving us the high price. So hopefully you've been able to work this out, but what this basically means is that the high price is the same as the closing price. So price closed at the top of the candle, which was also the high of that session. So as I say, this is a great example of a candle that takes quite a different looking shape and doesn't have all 4 reference points visible. However, it simply means that the close and the high point have overlapped. So we still know where the high was, we still know where the close was, and importantly we know that this is still a very bullish candle. Now we can also get candlesticks which look like this. You can see that this candle sort of looks like a cross or a sword, and what this candle is basically telling us is that price opened at this point. Okay, so again we have a green bullish candle. Price opened at this point. At some point it traded down to this low before reversing. At some point it traded up to this high level before again reversing and trading all the way back down to close at the same price that it opened. Okay, so again, all you need to do is get familiar with picking out these reference points and understanding what they're telling you about price, and then no matter what the shape or the size of the candlestick, you'll always be able to work out the story that the market is telling you about how price moved during that session. So as I say, candlesticks come in all shapes and sizes and tell us different things about how price moved, and over the years technical traders have worked out that certain shaped candlesticks can give very clear, strong indications about what price is likely to do next. So now you know what candlesticks look like and you know why they're important, and you had that fantastically short history lesson. Now we're going to walk through the key candlestick formations that you need to learn in order to analyze the market, and I'll explain what they tell us about price as well as how you can use them to trade the markets. So some candlestick formations are simply based on the shape of one particular candlestick, like we've seen in these 2 examples here, while other formations, more advanced formations, are based on the shapes of 2 or more candlesticks in a row, and what their shapes in relation to each other tell us about price. So first of all, let's start off with the basic 1 candle formations. And the first pattern that we're going to look at is the pin bar, which is an abbreviation of the term Pinocchio bar, referring to the children's story about the wooden doll whose nose grew longer each time it lied. So basically, the reason why this got its name is because you can see the long tail on this candle is referred to as a nose, and the candle is said to be lying because it essentially lies about its direction. So essentially what this candle demonstrates then, so this is the candle we're focusing on here, just this long sword looking like candle, and essentially what this candle demonstrates is a sharp reversal in sentiment. Okay, so looking at this bearish version first, we know again that price opened up at this point here, because obviously with bearish candles the close is below the open. So price opened up at this point here, buyers were in control, taking price strongly higher all the way up to this high level here before sellers stepped in and drove price all the way back down to close at this point. Okay, so when we see this candle form with this long tail and relatively small body, this tells us that there has been a really strong shift in order flow. So buyers who were in control initially have been overwhelmed, and sellers have stepped in to drive price all the way down to the low. So what this bar essentially does is highlight the fact that there has been a shift in sentiment and alert us to the potential of a larger reversal. So when we see a bearish candle like this, essentially what we want to look to do is sell as price breaks down below the low of the candle, as you can see here, anticipating that we'll get a larger reversal lower. Now, one of the keys to identifying the highest probability pin bars is looking for the size of the tail in relation to the body. Okay, so you can see here that this candle had a particularly large tail, and ideally what we want to see is the body always forming in at least the lower third of the candle. So that's what we're looking for. We're looking for the body forming in the lower third, and then we're looking for a long tail, and this highlights the best pin bar patterns to us. So again, looking at the bullish version of the pin bar, then it's simply the other way around. We know that price opened up at this point here. Sellers were in control initially, driving price all the way down to this low point before buyers stepped in to strongly drive price higher, taking it all the way back up to nearly the top of the candle. So close at this point here, and again, we know when we see this really long tail and small body that there has been an acute shift in sentiment. So sellers who were in control initially have been overwhelmed, and buyers have stepped in to drive price all the way back up to close at this point here. And when we see this candle form, we know there's a good likelihood that price is going to continue higher over the next candle. And so, as with the bearish candle, where we look to get short, which is putting a sell order on the break of the candle low, with this bullish pin bar, we want to get long, which means putting in a buy order on the break of the candle high, anticipating a reversal higher. So a quick question here from Bella: which time frames would you be looking at to trade these pin bars? Well, the majority of my trading takes place on the daily and H4 charts, and the thing that you have to bear in mind is that typically a lot of these candlestick formations on the higher time frames will carry more weight with them, though they might take longer to play out. I mean, if you're a short-term trader, so if you're trading intraday, if you're trading on the 1 hour charts or less, then you can still obviously take these patterns. You just need to be a little bit more careful about the location, because obviously the lower time frame charts are a bit noisier and the patterns don't tend to hold as well. But yeah, you can use these patterns on any time frames, whichever time frame you prefer to trade on. Okay, so that's the pin bar candlestick then. It represents an acute shift in sentiment. So as I said, this candle is a fantastic reversal signal, and it can be particularly effective where it occurs in certain locations. So for example, with a bearish pin bar, which suggests a reversal lower like we're seeing in this first example, we ideally want to see this candle forming at a resistance level. So you can see in this example here that we had a really strong resistance level at this point. So price had enjoyed a really strong rally up to this level here before sellers stepped in and drove price down. We got a reaction low here before price recovered and started to trade higher again. So once we identify an area where price is sold off strongly, we can go ahead and mark in our horizontal lines which give us a resistance level where we anticipate that price might struggle if it returns to that level. So then price trades back up to that level, and look what happens as we trade up to that level. Okay, we get a really big bearish pin bar. So again, what this candle tells us is that there has been an acute shift in sentiment. So we know that buyers were in control initially, but sellers have stepped in strongly at the high here and driven price all the way back down to close at this point. And again, we only look to get short as price breaks down below the low of the candle. So you can see the next candle doesn't break down below the low of the pin bar, but then the second candle does. So at the point that price breaks down below that candle low, that's where we put in our sell order, and then you can see we catch a really strong move to the downside. So this is a really simple and straightforward way that you can look to use these pin bars, simply identifying a key support or resistance level and then identifying a pin bar that occurs at that level to give you confirmation to go ahead and enter. Okay, so on to the next candlestick then, which is the hanging man. So you can see the hanging man here circled in blue. Now, it's important to note that unlike the pin bar, which has a bearish and bullish version, the hanging man is a bearish reversal pattern only, and it's found during uptrends. Okay, so the candlestick is essentially an early warning sign that bulls might be losing control and bullish momentum is fading. So the pattern highlights the first sign of sellers challenging the market. So where we see a few strong bullish candles like we have here, and then we see a bearish hanging man candle form, this is basically telling us that sellers stepped in at this point and drove price all the way back down to this point before buyers stepped in and battled price back up to this level here. Okay, so buyers haven't completely lost momentum at this point. However, this is a warning flag. It's an early warning sign that buyers might be losing control and that bullish momentum is fading. So again, in terms of how we use this candle to trade, in terms of waiting for extra confirmation, we always want to make sure that we get short on the break of the candle low, okay? So to reiterate what I'm saying about this candle, this doesn't tell us that a reversal is definitely underway. It's an early warning sign, a potential warning flag that buyers are losing momentum. So we don't want to go ahead and enter at the close of the candle because we are in an uptrend and buyers could still continue to push price higher. However, if we wait for price to break down below the low of this candle, then this is likely a good confirmation that a reversal is underway and that buyers have lost control. So again, the hanging man pattern highlights a potential loss of momentum by buyers. It highlights the first instance of sellers challenging the market. And so to go ahead and trade the pattern, we want to wait for price to break down below the low of the candle. And you can see that the second candle doesn't break down. Okay, so we don't get short on that second candle, but then on the first candle rather. But then the second candle that forms does break down below the low of that candle, so we will go ahead and get short. And the reason why this is such an effective entry mechanism is because if we were wrong about this idea, so if our bias was incorrect and we went ahead and entered our short trade simply at the close of the hanging man pattern, well, if the bullish trend continues, we're simply going to be stopped out as the next candle trades higher. Whereas if we actually wait for price to break down below the low of this candle, then that's giving us good confirmation that a proper reversal is likely underway. So it's just about adding in a little bit of extra protection to our trading ideas so that if we are wrong, we don't take unnecessary losses. Okay, and then the next pattern we're going to look at is the Doji pattern. And again, this is the candle that I showed you earlier that looks like a cross or a sword when we were talking about the different shaped candles at the start. So Doji is named after the Japanese word for fool or blunder, which really highlights what this candlestick is trying to tell you. It's a really popular technical pattern and for good reason. So the key characteristic to the Doji candle is that the open and close price are essentially at the same level. Okay, so this is what this is representing. So again, for a bullish candle, the open is here, the close is here. For a bearish candle, the open is here, the close is here. They're both at the same level. Okay, and basically, Doji candles are a market representation of indecision. It shows us that an equal number of buyers and sellers over the course of the time frame represented by the candlestick have balanced out, and we've opened and closed at the same level. So the Doji is a fairly common occurrence in a non-trending market. However, when we see Doji candles in trending markets, this can be a sign that the market is about to correct or reverse. So these are a really good candlestick to pay attention to when price is trending strongly, because it can be a really great early warning sign that the market is going to reverse. So you can see in this pattern, in this chart here rather, that we have a Doji candle here. Okay, so you can see this is our cross. Price is trading down strongly here. We're in a really heavy downward swing. However, as we get to this point, you can see that we get a Doji here, and then we get another really large Doji here. So we've got two Dojis in a row at the end of a bearish price swing. So this tells us that buyers have stepped in at this level and are really battling it out with sellers. And again, this highlights indecision in the market and a lack of momentum. So when we see these candles forming at the end of a downward trend, we can be on alert to a potential breakout higher. Now, in terms of how we trade the patterns, we'd simply look to get long again on the break of the candle high. So because this is a bearish trend and we form Dojis, we want to get long as price breaks above the candle high. If this was a bullish trend and the Dojis formed at the top, we'd want to get short on the break of the candle low. Okay, so whenever we're trading candlesticks, we always want to be looking to play the break of the candle, which refers to price moving either above the high of the candle if we're looking to get long and buy, or moving below the low of the candle if we're looking to get short and sell. Okay, so these are the three main single candlestick formations, And this is where the majority of traders begin their practice of reading candles and taking trades based on candlestick patterns. Now, once you're comfortable with these candlesticks and you've practiced identifying them and making some initial trades based on them, you can then move on to advanced candlesticks. So advanced candlesticks generally comprise of 2 or more candles, and so although a little bit more effort and focus is needed to spot them, they tend to be very rewarding. So over the rest of the session then, I'm going to explain to you about some of the most powerful candlestick patterns used by traders and explain exactly how you can use them. So the first candlestick pattern, advanced candlestick pattern rather, that we're going to look at is the engulfing candle or outside bar. So this is the first 2 candlestick pattern that we'll cover. And as I say, these might appear a little bit more complicated, but there's a really easy methodical process to understanding them. So just bear with me and we'll go through these. So the engulfing pattern consists of 2 candles, candle A and candle B. So candle A will be a smaller candle. So where we've got a bullish engulfing candle, we'll typically have a small bearish candle, and then the second candle which forms, which is the engulfing candle or the outside bar, is a large bullish candle which completely supersedes the range of the first candle. So what this candle shows us is that there is a strong reversal in sentiment, just like we saw with the pin bar. However, it's played out over 2 candles instead of over 1. Now, the engulfing pattern can be both bullish, as we've seen here, or bearish. So with the bearish version, what we'll see is a smaller bullish candle followed by a larger bearish candle, which again completely consumes the initial candle's range. So whenever we see these candles formed, this alerts us to the fact that there has been a significant change in market sentiment and that direction has likely changed, and this alerts us to the likelihood of a larger reversal. So again, with the bullish engulfing candle, we'd want to see this candle forming into a support level or during a bearish trend. And then again, with the bearish engulfing candle, we'd like to see this form into a resistance level, or we'd like to see it form during a bullish trend. Sorry, a bullish engulfing candle to form during a bullish trend, and a bearish engulfing candle to form during a bearish engulfing trend. Can be a little bit of a tongue twister. So if we look at this example here, we have a perfect example of how you can use an engulfing candle to enter during a trending market. So you can see that price is trending higher, and we've got that classic textbook formation of higher highs, higher lows, higher highs and higher lows. Now at this point here, you can see that we get a shallow pullback in price, we get a little bit of consolidation, and then here you can see that we get a small bearish candle, and then the next candle that forms is a large bullish candle which completely overwhelms the range of the initial bearish candle. So this tells us that buyers have stepped in force, completely overwhelmed sellers, and this is a strong indication that price is likely to trade higher. And so again, we can get long on the break above that candle high, and you can see that this allows us to capture the rest of this bullish trend. So just these simple candlestick patterns can be a really fantastic way to gain entry to fast-moving markets and capture large price moves. So just learning to understand what these basic formations are telling us about price and the way the market is moving can allow us to actually take positions in the market and stand to profit from them. Okay, so the opposite then to the engulfing candle or the outside bar is the Harami candle or inside bar. And this is where we see a larger candle followed by a smaller candle. Now the larger candle is often referred to as the mother candle because it essentially represents a mother with a child inside. So we have one large candle and then a smaller candle which forms inside the range of the large candle. So a bearish inside candle forms where we get a large bullish candle followed by a small bearish inside candle, and then on the other hand a bullish inside bar forms where we have a large bearish candle followed by a small bullish candle forming on the inside. Now you'll often find these patterns following extended moves in the market, and what these formations typically show us is that momentum has stalled but hasn't reversed. So where the market expands quickly and makes a large move, it then needs to wait to clear orders, and this reduces liquidity before the market can continue. So the market consolidates and creates this inside bar pattern. Now the pattern can prove particularly effective at highlighting breakout trading opportunities, because the market moves in a pattern of trend and range, expansion and contraction. And the presence of this candle can be a great signal of a potential expansion about to happen. Okay, so this can be a particularly useful way of entering trending markets. So let's take a look at an example of that. Okay, so here you go. You can see we had sterling CAD, we traded up, we moved up into that resistance level. This is the example we used where we had our bearish pin bar, and then from that level you can see that price sold off. So we broke down through that support level, traded down to this low here, put in a new support level, and then broke down through that. We traded down to this level and put in a new support level. So at this point we know that we have a clear bearish trend in play. Okay, so we've got a high, a lower low, a lower high, a lower low, a lower high, a lower low, a lower high. And so at this stage here, look what we see happen. Price breaks down below that support level, pushing down to new lows in the trend before momentum contracts, and then you can see that in the next candle that forms is an inside candle. So we get that large mother candle forming, and then we get the smaller inside candle which forms inside the range of that initial candle. And again, this tells us that the market has moved very quickly and is now clearing orders, so momentum has contracted for now before you can see on this next candle price breaks down below the low of the mother candle rather, and then continues to sell off. So again, where we're looking to sell a inside bar, we look to get short on the break of the candle low, and if we were buying, we'd look to get long on the break of the candle high. Okay, so is everyone following along with this so far? I hope you can see just how effective and useful these candles can be and how simple they are to spot. And really all we're doing here is using simple structural analysis, highlighting support and resistance, highlighting a bearish trend in the market, and then using the presence of this inside candle to give us a signal to get short. Hi Bella, I thought the inside candle had to be inside the body of the candle. Apologies, sorry, I simply mean inside the range of the whole candle. So from the candle low to the candle high, the inside candle has to form within the range rather, yeah, well spotted. So yeah, just to reiterate that, the inside candle needs to form inside the range of the mother candle, not necessarily the body. So where we have a bearish candle, it needs to form inside here, so between the low and the high. Okay, so let's move on then and take a look at our next advanced candlestick formation, which is the evening star. So the evening star pattern again occurs during an uptrend and is a bearish reversal pattern. So the first candle in this pattern is a big bullish candle like this. And to the casual observer, at this stage, buyers appear to have full control. So we've had a strong bullish candle, and then we've had a candle which is a doji essentially. And so if you ignore these candles for the time being, and you're simply looking at these candles, you might think that bulls are in control and they're taking price higher. However, on the third candle, we then see a breakdown. So we get a large bearish candle which breaks down lower. And this confirms our evening star. So essentially what we're doing here is identifying a doji candle with a confirmation candle. So we're waiting for a candle to break down to confirm the reversal, which we suspect might be coming based on the presence of the doji. So when we see this formation occur, what we want to look to do is get short on the break of the bearish candle low. Okay? So when we see this 3 candle formation occur, we want to wait and sell as price breaks down below the low of the bearish candle, which confirms our bias. Now, once again, because this is a bearish reversal pattern, we ideally want to identify this pattern either occurring at resistance levels or occurring during a correction within a bearish trend. So if price was selling off in a bearish trend, and then we got a small correction higher like this, and then the presence of an evening star pattern, this would be a great signal to get short, anticipating a resumption of the bearish trend. So the counterparty to the evening star then is the morning star, which is the bullish version of the pattern. So this pattern will only form again in a downward moving market and suggests a bullish reversal. So this is simply the opposite to what we saw with the evening star. So the pattern is highlighted initially by the presence of a large bearish candle, a doji, which is the morning star here, and then the presence of a bullish candle. So again, when we see that bullish candle form, which confirms the morning star pattern, we then look to only get long, so we only look to buy price as it breaks out above that candle high. So in this instance, you can see the next candle that formed after the third candle, so after this large bullish candle, didn't break out above the high of this candle. It was actually the second candle which formed, which traded up and broke out above the high of that candle. So once again, what we're really doing here with this pattern is identifying a doji with confirmation. So instead of simply entering as price breaks above the high of the doji, we're waiting for a bullish candle to confirm our bias that price is likely to reverse higher, and then we're waiting to enter as price breaks above that candle high. So again, these can be really fantastic setups to identify in trending markets and can help you capture some fantastic reversals. And the beauty of waiting for extra candles to form like this is that it simply gives you more weight and more conviction in your trade. So this should appeal to the more conservative traders among you. So I mean, the more aggressive traders among you will probably just be thinking, well, I understand that the doji highlights potential reversal and will look to trade the doji, but then the more conservative traders can wait to trade the evening star and morning star patterns where we get that extra candle forming which confirms the reversal. Okay, so the next formation that we're going to look at then is the falling three. Okay, and although this pattern, has to be said, is something of a rare occurrence, or rather it occurs less frequently than the other patterns do, this pattern really should be acted on when it does present itself because it offers a high probability potential for capturing a move. So the pattern is essentially a bearish continuation pattern. So what we see here is a large bearish candle followed by three smaller inside candles which, as Bella pointed out, occur inside the range of the mother candle. So not the body, they occur inside the range of the candle. So the market grinds higher with these three smaller candles before we then get a fifth candle which completes the pattern, and this is a large bearish candle. Okay, so when we see this candle forming, we can get short as price breaks down below the low of that outside of that first candle. And essentially what we're seeing here is again the market demonstrating the way that it moves in terms of expansion and correction, because the first candle is obviously where all the momentum is in the market. It makes a large solid move lower before then we get this grind higher. And I say grind because you can see the scale of the smaller candles compared to the larger candles. So this means that there really wasn't much movement here. We're only making very small incremental steps higher before wallop, price gets driven lower again. So this is expansion, correction, and then continuation. So when we see this pattern forming in a bearish trend, this is a fantastic pattern to take, which highly signals the high likelihood the price is going to continue lower. So again, you won't find this in bullish markets because this is a bearish continuation pattern. However, the bullish version of this pattern, and the last pattern that we'll look at today, is the rising three. Okay, so this is simply the opposite of what we just saw with the falling three pattern. And this is the bullish version, and this is highlighted by the presence of a large bullish candle and then three inside candles which form inside the range of that initial bullish candle. And again, what we're seeing here is expansion to the top side, a correction lower, and then boom, another expansion to the top side. So again, what we look to do here is get long as price breaks out above the high of that initial large candle. So as I say, what this pattern is highlighting is expansion, correction and continuation. And if you think about a trending market, that is all that's ever happening. So where we can identify these candlesticks in trending markets, they can be really fantastic opportunities to enter a trade. Okay, so that completes today's session on candlesticks. Thanks a lot for joining me. I hope you found that session interesting and useful. We covered quite a few different candlestick patterns here. So for those of you who are new to trading Forex, what I suggest is that you focus on 2 or 3 to begin with. So maybe focus on just the basic candlestick patterns for now, or maybe pick 2 of the basic ones and 1 of the advanced patterns, and really focus and practice on identifying them on the charts and analyzing the market based on what those formations tell you. And then as you get comfortable and confident using those patterns, you can then add the others in slowly and build up to using all of them. Okay, so before we wrap this up for today, are there any questions I can answer for anyone? Yeah, the recording of this webinar will be sent out, so yeah, you can review this in your own time. Don't worry. Great. I'm pleased that you found this so interesting and useful. And yeah, best of luck trading, everyone. And I'll catch up with you all next time for the next session. Thanks a lot. Take care.